Hi, everybody. Welcome back to Capital Consumption Theory. I'm Eddie Chu, and today we're with Brian Winters. Today is April 29th, and I wanted to talk today a little bit about Chairman Powell's speech yesterday, and about the sort of um, difficulties that standard economics thinking has with things like inflation, um, full employment, and things like this. So I'm going to go ahead and play that clip right now so everybody can see it. This is a question that one of the participants asks Chairman Powell. Can you see that, Brian?
Before making that move.
Yep.
But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. You know, it seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
So the question is, Powell has talked about, how they watch inflation expectations very carefully, and they are ready to, tighten policy if they begin to see inflation expectations rise, maybe too far. And her question is, in the case that you had because Chairman Powell is also saying at the same time that we still have a lot farther to go. The economy still has a lot farther to go. We're very far from full employment. And so her question is, if we start to get inflation expectations rising at the same time that we have not yet reached full employment, then sort of what do you do then? It's a great question. Here's Chairman Powell's response.
Right. So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time. And you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, were we to reach that sort of pretty unlikely state.
Okay. So Jerome Powell. So Powell's view is that this is sort of unlikely, and if you've taken Econ 101, this is a sort of the classic idea about inflation. And if you remember from our last or previous episode, Stephanie Kelton talks about it also, and you can see that she is also using the same paradigm where inflation, where you have this, you kind of sort of try to keep the economy like not too hot, not too cold, and then if you overheat the economy and you get too much spending, I guess, and too much growth, if you overheat the economy, then you have inflation.
So we've been targeting 2% inflation for a while now, right? And failing to meet that target.
Absolutely.
So in order to balance out for 2% for the year or something, we'll have to go over it. We would have to go over it slightly to have it average back out.
Sure.
2%.
Yeah, and that's the new idea in the last I think 2 years with the Fed. But I would argue that that is sort of that's fine. That's fair enough as it goes. But I would argue that the fundamental the understanding of inflation here is actually lacking. So one of the problems I have with how a lot of economics is done is that it's too theoretical. You go from theoretical arguments to theoretical arguments to theoretical constructs, and it just kind of loops around and doesn't actually connect to the real world. And if you want to have a science which um, has a good understanding of the real world and how the real world works, and how different what effects different actions would have. You need to be able to go back and forth between your theory on one hand, the theoretical construct on one hand, and empirical data on the other. You have to see if your theoretical ideas match what you actually see. So with this inflation, the standard idea is that there is, what, so one of the ideas is sort of this wage price spiral. So there's one idea that, like if wages get too high, then that brings costs up, and then businesses have to have higher prices, and then the workers want even higher wages because now the cost of living is rising. um, but there's this idea, and Powell talks about it, and most people talk about it without even thinking about it, pretty much as a like a default. Like, people assume that this is just standard proven theory, that this is definitely true. So one of the things we should do is look at the data and say, when you get to full employment, the theory is that when you get to full employment and the labor markets are getting tight, then that puts upward pressure on wages, and you tend to get tend to get inflation. Inflation is due to tight labor markets, basically, right? That's the idea.
And inflation can be related to a bunch of things. But yeah, tight labor markets certainly wouldn't
Right.
help.
There's definitely a lot of other things, but tight labor markets is something that's talked about all the time. That is something that Powell talked about just then. He said, we don't have to worry about inflation because we still have unemployment. We don't have tight labor markets. We don't have rising wages, so you don't have to worry about inflation. So let's go to our data here and take a look at unemployment and at inflation. Let's see. Let's share this. Mhm. Sorry. Okay. And the other thing, which I think is needs to be pointed out, that it's sort of wrong, is that the default that people think about is the 60s and 70s, because that was the last time we had a lot of inflation. And so people sort of by default compare our current era to the 70s, which is wrong. They're very different, and we'll go into why they're different later. But let's take a look first at inflation and unemployment. So you see that inflation, as most people know, it's kind of spiked in the 70s. You've got a peak here at 1980, 13% inflation, and then after 1980, it comes back down. And then, for the last 20 years, we've had fairly low inflation, close to 2.5%. So remember, our theory says that inflation occurs because that labor markets are tight. So you would imagine that, based on this theory, that you would say that, if you have an inflation chart that looks like this, then what you would see is that, sort of maybe, because this inflation sort of starts going, in the late 60s, and it sort of, you can see it sort of gradually rises to a peak in 1980. So you might expect to have like sort of tight labor markets, low unemployment from maybe 1966, and it should sort of get tight, stays tight, through at least the late 70s, to drive this inflation. If tight labor markets are what causes inflation. So let's see if that checks out with our data. So you have 1965. So this is unemployment. So tight would be sort of like low, low unemployment, low unemployment. And this is, this is from 1950 to 2020. So one thing is that, the 70s, with all of the inflation that we had, was actually a period of relatively high unemployment. You actually had relatively high unemployment at the same time that you had inflation. So that doesn't really fit with that theory. The other thing is that you have, it's sort of level across the whole chart. Like, you have spikes and dips with recessions, but from 1950 to 2020, the 7-year period, um, it's relatively sort of flat. You do have, very low unemployment in by 2019, 3.6%. But again, you don't see a commensurate, like a rise in inflation due to that very low unemployment. So what's going on here? This doesn't make sense.
Some people will tell you that inflation is just around the corner and has been for decades and decades, but
Right.
it could be real this time, and there could be a big, massive inflation.
Right. Well, no one has a perfect ball on the future, a perfect beat on the future. So there's always a lot of space when you say something like that. But even if you felt that inflation was coming, um, you know, that if it's a valid, then you have some type of model, some type of theory that is saying inflation is coming, if that's what you're saying. And so if you were to say that, then you should also at the same time look back at data and say, this is my model, this is what it says should happen. Is that what we see actually occur? So that's actually a different idea. That's actually, more like a little bit more of the severe inflation, hyperinflation dynamics, which, capital consumption theory says that is an opposite effect, as regular, capacity constrained inflation. So capacity constrained inflation is too much spending chasing too little capacity, too little capital. So too much consumption chasing too little capital is capacity constrained inflation. Hyperinflation, in the CCT view, is too much capital chasing too little consumption. So so the unemployment, that doesn't really seem to work very well. But so capital consumption theory, and there's like some economists will talk about this sometimes, but surprisingly little. So from CCT view, when you're looking at capacity constrained inflation, you should be looking at capacity. You should be looking at capacity utilization. And the theory here, the hypothesis is that when when businesses reach capacity, as long as they're below capacity, any extra spending that they get, they're going to tend to like say, okay, wonderful, we can produce more with with the machinery that we have. That's wonderful. Let's get that out the door. But when you get to a point where you're close to capacity constraints, and a lot of the businesses in the economy are saying, this is all we can produce. We cannot produce more on a short-term basis, and the spending is still rising, then that's going to push, and that's going to give you inflationary pressure, because the businesses are going to say, given that we cannot increase volume, but we want to maximize our profit, how do we maximize our profit when we're at full capacity? Well, the easiest way is to raise the prices. And you can do that because spending is trying to kind of overwhelming your supply anyways. So if you raise prices, you can still keep your factories busy, and at the higher prices, then you get higher profits. But when the whole economy gets in this way, then that is the inflation pressure that you get. So this is the hypothesis that I'm saying is correct. Do you have, Brian? You have a funny look. I don't know if you have questions or.
No, I was comparing this chart to the one you showed of the unemployment rate, and you can
Yeah.
see sort of the spike in inflation in 1980, and
Yeah,
then inflation going down over the next couple of years.
yeah,
And then in your unemployment chart, it's sort of reversed, where it's a kind of a low point in
yeah,
1980, and then it
yeah,
climbs over the next couple of years.
yeah. So there are some like sort of short-term effects. And if you remember, like, 1979, late 70s, 1980 is sort of when Volcker is deciding, okay, we have both the unemployment and the inflation. Which are we going to do? Let's tackle the inflation first. So he raises interest rates very high. You get a recession, and you do, like, for instance, like for if you look at 1980 to 1982, you have a sort of a recession. And then after there's and the recession, at the same time that you're having this recession, inflation is coming down. You have another recession in 1982. That's the gray shaded areas. It comes down from 1983, and then it never goes back up. But the short term, there's some effect, but there's a larger question here of, like, in the 60s you have low inflation. In the 90s and 2000 you have low inflation, but in the 1970s to 1980 you have this fairly significant peak of a high of a 13.5% inflation. There's something that would seem to need explanation. Like, why does inflation go up from the 1960s through the 1970s and peak in 1980? And then after 1980, why does it never come back? And if you're trying to explain that with unemployment, across that entire range, that doesn't look explanatory at all. If you try to predict what inflation would be based on unemployment rates, you would never get it right if you didn't know what inflation was already. I mean, if your idea, the hypothesis is that low unemployment rate, tight labor markets drives the inflation, then you would say, okay, 2018, 2006, 2000, we're going to have high inflation at all of these points, 1953. And it's not, it doesn't match. It doesn't match up at all. It's really um, fairly useless to try to predict inflation based on the unemployment rate. And this is very interesting because this is Federal Reserve Chairman Jerome Powell, talking about how you don't have to be worried about inflation because unemployment is high. So clearly, his model that he's using, his idea, is that these two things are related, and that enough that you can rely on it to say that probably if you have unemployment, you're not going to get inflation. And you would think that, as chairman of the Federal Reserve, that he's an expert on economics, and that he probably should have the right idea. But if we look at the data, at least a straight relationship between unemployment and inflation, it's simply it's not it's just not there. It's just not. It just doesn't work that way.
So, do you think you'd see a slightly different relationship if we had a better unemployment number, whereas the unemployment number only covers people who are actively seeking work and
Yeah.
that kind of stuff? If there was a
Yeah. Well, I
broader
mean,
unemployment number,
yeah.
it'd be more
There's a
correlated.
broader number. I mean, you also have, like, the participation rate, and that doesn't do things. I don't have them up, but I've never seen any particularly close relationship. But my point is that we have something that does have a close relationship. So, and it has a theoretical reason. So at the level of theory, again, what is going to give you capacity constrained inflation is high capacity utilization. When businesses have trouble increasing their supply volume, the volume they can produce, because their factories are already completely busy. So they can't right away just produce more volume. Then theoretically you would think that their incentive would be to raise the prices. So theoretically you would think that. And if you look at the data, so here's inflation again, spiking in the 70s, as everybody knows, and here's capacity utilization. unfortunately, I wish this went back earlier. This chart went back earlier, because you can't see what it is in the 50s and the 60s. But based like Ray Dalio has a number, in one of his articles, with capacity utilization in the 70%, around 70%, and falling into the 60s at the time of the Great Depression. So I don't have the exact data between 1967 and 1930s. There's 30 years of data in there, but I would be willing to bet that it goes from the 60s and it goes up. So the data that we have that's very, very clear is from the 1970s until now. And so this this pretty much looks like what we would expect it to look like from our hypothesis. You have high capacity utilizations in the late 70s, in the late 60s, and the 1970s. 1980 is the peak of inflation. After 1980, you come down. So here's those two recessions that you had in the early 80s. And that dips your capacity utilization down to like 70%. It recovers, but it never gets past 85%. And then from 1990 until now, it never goes above that 85%. And the long-term trend is down. So if you were to look at this chart and using our hypothesis that capacity constrained inflation occurs when capacity utilization is very high and businesses are, they have tight capacity and they cannot increase their volume, then your prediction would be that, from 1988 onwards, that you don't have very much capacity constrained inflation, and that is what you see. Inflation comes all the way down in 1983, and it never really goes back up. The highest is 5%, and it has that same slight downward trend from then until now, and it has that upward trend, from the 60s to the 70s when that capacity utilization is high.
Looks good.
Yeah, I mean, right. To me, like, the theory makes sense, the data fits it, but the funny thing is that economists just do not talk about capacity utilization. If we add a little bit more to this theory, there's some more. So capacity utilization is looking at like how much of the built out capacity that you're using, how much of your factories in your economy are you using. There's other things sort of above that, which is that you have the potential that you can build more factories, right? You can build more factories. And the capital consumption view is that, so if you have like sort of a lot of savings, then you could theoretically use the savings to build more factories. But the CCT view is that what happens is that the whole thing becomes constrained by spending. That you have the savings present, you have what economists now start to call like a savings glut. The savings is there, and because people have savings, that savings could be invested into real productive capacity. But because you have underspending, underconsumption, then that capacity cannot get built, because if it were built, it would be sort of unprofitable, because you would not be able to sell the increased production. So the measure of that is interest rates. So if you have so this is 1970s. This is what I'm calling too much consumption chasing too little capital. So if you think of consumption as pulling the real investment, and then the real investment is pulling on savings. If you're kind of pulling too hard with too much consumption and too much real investment needs, but not enough savings, then that is going to be like a lot of demand for savings with not enough supply. That's going to raise the price, which is the interest rate. So here's the 10-year Treasury interest rate. The 10-year is a market rate, so it's not directly controlled by the Fed. The Fed does not, actually touch this market rate. The Fed works closer to the very short term treasuries, and for the most part. But right now they have a little bit longer term, like 5-year stuff. But 10 years is fairly market, is fairly pretty much a market rate of interest. And so you see, again in the 1970s, interest rates going up, which from a CCT view, this is a reflection of too much consumption, too much need for real investment, and not enough savings to provide for that. And so that price goes up. And then you have the opposite dynamic from 1980 onwards, that over this period, your savings you're moving towards the opposite end of imbalance, where you had too much consumption, not enough capital here at the 80s, and then to the present era, you have too much capital, too much savings, and not enough consumption, and not enough real investment. And so having not enough real investment, that is going to sort of bring your market interest rates down. So that's sort of like the next level when you're thinking about the potential capacity of the economy. Part of it is how much savings is available to make more investments. And so if you don't have enough savings to make more investments, then you end up with these high interest rates. If you have lots of savings but you cannot make the real investments because consumption is too low, then that's the period that we're in, and you have these persistently low interest rates.
And so where do you see that trend going over the next 5 years? Obviously, it can't go down below zero.
Right. So in the next 5 years, there's two cases. One case is that we sort of get a UBI, and one case is that we don't get a UBI, and we try to they try to make the system work as it is. So if we do not get a UBI, then there's nothing else in the system right now to really turn it around. I mean, we're getting stimulus payments in the last year, which is a little bit like a temporary UBI. So we're sort of getting some help in the last year. But if the politics goes that we don't get the UBI, and then they say, okay, coronavirus is over, no more stimulus payments, and then there's no more. If there's no more stimulus payments for the next 5 years, I see this continuing in the way that it's going. And the way that it's going is that you're sitting on the zero lower bound. The Fed hit the zero lower bound for the first time recently in 2008 with the global financial crisis. They figured at the time that they would have this recovery, and after the economy recovered, that then they would start to raise the rates again. But so they waited like 4 or 5 years, and then they started to raise rates a little bit, and all the stock markets just they had what people call a taper tantrum, like, oh no, the Fed is tapering, QE, this is terrible. All the markets started crashing. The Fed, although they would not admit it, got scared and said, okay, fine, the QE's back, don't worry. And then the markets continue to go up. And so what we have here is that the Fed, even though they won't admit it, essentially, and they may not understand it this way, but essentially what's happening is that you're using monetary policy to hold up like these asset bubbles. And you're using asset bubbles, I would consider them almost as sort of like a mal-designed UBI. Like, it is not a very good, consistent UBI, but there is a real effect where, even if you're like a 30-year-old and you've got like a $10,000 portfolio, and then half of it you put in GameStop, and then that goes up 5 times, or you invested in crypto in 2013, and that went up 100 times, 1,000 times, 10,000 times, because it started at cents. The first rally was to $10. Now you're at 50,000. So that is 5,000 fold growth. That is now like sort of an extra $1 trillion in the quasi money supply, like not the actual money supply, but if you thought of it sort of in a more broad sense, and you included financial assets, and that goes for stocks, that goes for real estate. So a lot of people, if they don't have money to spend, what do? Well, their home has been appreciating for the last 20 years, really well, and they go to the bank and get a line of credit off of their home equity and pull that out. So you're sort of providing UBI to the economy that it needs, but you're doing it through assets, which is not really good because it goes to the top. It doesn't really go to the bottom like it needs. And the other part is that it is unstable, because just like in 2008, and again, like right now, just like in 2000, market participants will look at it and everybody is scratching their heads and they're like, these prices look a little bit too high. I'm worried about it crashing. I might want to get out. And then if enough people panic, then you have a sudden crash like 2000 or 2007. And there is, but we're taking this. So you have the economy trying to crash because the bottom of the economy is deflationary on the one hand, and on the other hand, but the Federal Reserve and the fiscal policy also, because fiscal policy starting even in 2019, prior to the pandemic, Trump was already doing 1 trillion in deficits on what was supposed to be a solid economy at that time, 1 trillion. So you've got the monetary policy and the fiscal policy trying to hold everything up. You've got the economy trying to crash, but you're going to keep fighting. And one of the ways that it could, one of the ways that it could end is that you're sort of supporting the economy through the government balance sheet and through the dollar. You're supplying, you're printing more and more dollars to hold those assets up. And one of the ways it could end is that right now you have assets as a result going up and the dollar going down against the assets. But it would be a bad scenario if, the next time assets crash, if they, those people decide that they don't want to be in the dollar either. They figure the dollar is going to lose value, and their actions will cause it to lose value. If everybody is trying to get out of the dollar, stay out of the dollar, then that will tend to cause the dollar to lose value, to be more likely to lose value, and you can have a crash of the dollar.
Anything else you want to cover tonight?
No, I think that's it. Right. So we wanted to talk about inflation, and that's the opposite effect. And again, like to go back again to the way many people are seeing it the wrong way. They have, it is wrong to assume that the danger is the economy overheating. The economy, based on measures like the treasury rate. There's one more measure here that I wanted to show you, and this is wages and salaries growth. So this is the growth of wages and salaries, and you can see that same up and down trend that peaks at 1980, and ever since 1980, the wage and salaries growth has just long term gone down, and down. So this is a reflection of spending not fully utilizing capital, the savings in society, the capital in society, and spending also not fully utilizing labor, And the mistake that most economists make is just looking at the unemployment rate, which is like sort of a volume, but you also have to look at price, because in other wages. In other words, wages. So if you're running the economy very at full capacity and keeping it at full capacity, you're going to have more labor demand. You're going to have, more high value jobs, just because proportionally, even if the proportion stays the same, but the total demand is up because spending is up, then you're going to have more high value jobs, which is going to suck more of your labor into into higher wage jobs, and the lower wage jobs are going to tend to be automated more, replaced with productivity growth. So that's, inflation, unemployment, and sort of these are sort of the measures that we use to measure, the capital consumption cycle, and this is, how through, in capital consumption theory we understand the economy is by looking at these things. Wage and salaries growth, 10-year treasuries, and capacity utilization. And that is sort of the data that fits into the theory and sort of helps us make sense of, a lot of very strange things that are happening in the world, and sort of a lot of, unprecedented things, and questions about, like, now that you're down to zero, what happens next. It is a hard question to answer. It's a question that most people, most economists, most people in finance are completely scratching their head about. They have no idea. They don't know if we're going into deflation or inflation. Interest rates are down, but surely they can't stay down forever. Are they going to go up? But if they go up, then where's that going to come from? Because we don't seem to have any demand. So this is sort of, CCT kind of just answers all of those questions, um, based on the data, and based on a simple, but I would think is a more correct understanding of what's going on. So I guess I guess unless you have any questions or thoughts, I guess we could just end it here. So thanks everybody for listening, and look forward to seeing you, Brian, and seeing everybody next week on
All right.
capital consumption theory. Thanks.